This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Samara Gordon of Hyperplane Venture Capital. Samara, thank you for joining us.
Thank you so much for having me.
So what was your background before investing in early stage companies? What did you do before this?
So I started my career in product. After graduation, I joined as a very early employee in a fintech startup in Boston, I was the first person working on their product as a product manager. And while I was there, I was sort of spending nights and weekends working on a predictive analytics company that I had started with a professor of mine at Penn. And so I worked on building that business for a few years. I went full time, and that's actually when I first met Hyperplane. I pitched to them on the other side of the table before I ever got into VC. And from there, I ended up linking up with a European management consulting firm that was growing and wanting to launch their practice in the US. So I moved to New York to help start their US office and spent a few years sort of traveling the world and working on all sorts of different strategy projects for mostly larger companies. So I would be 1 month in Brazil launching a new market for a CPG brand, and the next month in a small town in Alabama working out of a manufacturing plant, aluminum manufacturing. So kind of ran the gambit in terms of industries that I got to work on as a consultant. And then one day got the call from Hyperplane. They were scaling up and looking back on some of the entrepreneurs that they had met. And I was lucky enough to kind of come to mind as a fit. So I jumped on the opportunity and moved back up to Boston to join Hyperplane.
Well, that's great. So what excites you right now?
Yeah, so there are a lot of things excite me. I mean, we're a tech-focused fund. And so I'm really lucky in that I get to see all kinds of awesome new tech pretty much on the daily. So I've had to kind of curb my enthusiasm around some of these really futuristic, cool new frontier tech applications that are coming out. So things like brain-machine interface and robotics and next-gen sequencing are all areas that excite me a lot. But what really excites me is when a technology like this, a kind of futuristic, cool, fun to play with technology like robotics has kind of combines with an actual business plan that makes sense. And more than just that is the entrepreneur behind it, who is not only a killer technical founder, but someone with real business sense. So I've kind of reduced my excitement from being excited about any new tech to a tech that I think there's a business model behind it that makes a lot of sense.
Well, that's a good idea. Get a business that has not only tech, but also a business case for it. So what's your advice for people investing in early stage tech startups? What do you advise them to do before they write that first check?
Yeah, so one piece of advice that I have is if you are going to invest regularly, try to commit to a strategy around a check and round size and sort of the target ownership that you're going after. I think that if you want to double down and write a larger check on a company that's really taking off, that's one thing. But I think there's a trap that investors sometimes fall in when they lack some conviction, and then instead of kind of digging in deeper or working with the company to fix some of the things that they see as problems with either the business or on the product side, they just write a smaller check and they try to de-risk the investment in that way. And I don't think that's a great strategy that works out for the investor or the business. So, we are a seed fund with a pre-seed strategy, but I think it can be tempting sometimes to say, oh, we'll write a smaller check, and that might make it easier for us to get on board of an investment that you don't have full conviction around. And I think that's a mistake. I think you should be clear really what is your strategy for how you want to invest in terms of the mechanics of the deal.
Great. So what's your advice for people running startups in the early stage? What do you advise them to do before they launch that business?
Yeah, so I think it's never too early to really think about the business fundamentals and the go-to-market strategy and sales, even in the really early days. I have yet to have a founder tell me that they hired a salesperson too early. In fact, I think one of the biggest differences I've seen between the ways that really experienced entrepreneurs build their business versus newer ones is when and how they make that first business and sales hire, whether it be a CRO or head of sales. I always advise companies to really think about commercialization right there as they're speccing out the product and not wait too long to start coming up with that strategy.
Well, that's good advice. So let's talk about the state of investing in early stage tech. How do you see the industry evolving and what changes do you see coming up?
So I think a lot of people have written about how seed is becoming the new A and A is becoming the new B, and these round sizes are getting bigger and bigger. I think that it's not so clear cut as seed is becoming the new A and A the new B. I think it's just getting messy. Rounds are getting just messy in general, and it's causing a lot of confusion for funds and for founders who are trying to navigate the fundraising space. And I think we're going to see some clarity kind of being forced upon investors and founders to really raise. We're seeing sometimes investors come in and pitch us with, oh, we're raising a $10 to $15 million seed round. And then we're like, first of all, that's not really a seed. Second of all, that's quite a large range. What's the money that you really need? And I think funds are also figuring out, investors are kind of getting a little bit more strict on what milestones they want to see for the stage that they are investing in, and that this landscape will get a little less messy than it is today.
Great. Well, we've been in this economic expansion for quite some time. It seems like we're near the end of it. What do you think the impact on the startup community will be when it does end?
You said it, though, in terms of the more money being available today?
Right. As the economic expansion grows, there's more money available. Companies are staying private longer. The rounds are getting bigger. But at some point, the music stops and everyone has to find a chair. And what do you think happens then at that point?
Yeah, I mean, I think we're going to see a lot of consolidation in certain industries where, especially around some of the emerging tech from the early 2000s and late 90s, I think there's been a proliferation of companies using AI for various business use cases and big explosions in CRM and different SaaS offerings that I think we'll see a lot of consolidation. I think we'll also see in industries in products around cryptocurrency, blockchain. These startups were lucky. A lot of them got lucky and got funded before really proving out their models. And I think that's where we've already started to see some consolidation and a lot of pivots in spaces like that, since these companies are struggling to raise bigger and bigger rounds without milestones of product market fit.
Well, I agree. I think it will reset back down to more sane levels. But let's talk about your investment thesis for your fund. Tell us more about what you guys are doing there at Hyperplane, and what is the exact thesis and what do you look for in startups?
Yeah, so as I mentioned, we're a tech-focused fund and we're in the early stage, so focused on seed and some pre-seed investments. And we invest in B2B companies, but our investment thesis sort of spans the technology stack. So from applications to infrastructure and kind of across the enterprise spectrum. Also invest across a lot of different industries. But what we're really looking for is tech and team. And as I mentioned, looking for both technical founders with that strong business sense. So from deep tech applications in, as I mentioned already, robotics and healthcare, fintech, insurtech, ag tech. These are all industries we've invested in. And what we're looking for is smart applications of frontier technologies, a lot of machine intelligence and artificial intelligence applied to business problems and smart applications for how to utilize data. So we've ended up investing in and get really excited about machine intelligence companies pushing frontier to the forefront of industries.
Well, can you talk about one or two startups that fit that thesis?
Sure. So some of our recent investments in robotics, we invested in a company called Dexi that's bringing robotic software to fast service restaurants. And this is an application of robotics and the new tech in robotics and software that we think makes a lot of sense in an industry that needs this automation. Pickle Robot is another company we invested in the robotic space that similarly found a use case that makes sense for this new technology in package handling and delivery. And another company that kind of fits our thesis is Link Squares. So that's AI powered contract analysis and management. And that's an example of a company that what we get really excited about is a smart use for AI in a big business need and large market, with just a killer team that knows how to both build great software and sell it and get customers really excited. So Vishal over at Link Squares is just a powerhouse CEO that really knows how to manage a very technical team and celebrate a sales organization and really can kind of put on both hats and really lead a high growth tech team.
Great. Well, you see a lot of startups launching and growing. If you had to pick one or two challenges that they all face, what would you put the top one or two that you see your startups going through to make it successful?
So I think one of the biggest challenges, sort of a general challenge that founders face, is that you're getting conflicting advice about needing to have 100% conviction around what you're building and the approach that you've taken to solve the problem you're working to solve. But at the same time, you need to be really flexible and adapt to market dynamics or customer needs. So what investors are looking for and what you need to be confronted with on a day-to-day is, I am the right person to do it. This is the right solution. Let me go out and convince customers, investors, new employees that I want to join the team that we have nailed it and we've come up with something that's going to work. But at the same time, you need to wake up every day kind of questioning, where were my assumptions wrong? What do we need to change? And I think that's a really hard thing to do, to play both at the same time. So I think that's what's really hard about being a founder. It's also, this is said quite often, but it really is a lonely job. And I encourage all of our founders to make sure that they have either a CEO coach or maybe it's someone on their board that they can talk to. Certainly people outside of the business of their business that's there for them to get them through some of the lonely, dark moments of being a founder.
Well, that's good advice. So you see a lot of different sectors and applications out there in the early stage space you play in. If you had to pick one or two that are good opportunities for investors to look at today, what would you call out?
I think people are talking a lot about data privacy and security. So I think that solutions are starting to emerge that should and can really take off. Multi-party computation is a subfield of this space that I think is going to be opening up a lot of methods for businesses to take advantage of their data and to share data in a secure way. So it allows two businesses to share, or two parties to share inputs, but keeping their data private, except for either an overlap that should be shared or the ability to kind of run analytics on two data sets without exposing the core data. So I think there are smart companies out there that have been thinking about this, and then the need is real. I also think that 5G infrastructure is opening up a lot of new business opportunities in IoT, autonomous vehicles, remote patient care is a big one. So I think paying attention to kind of how new devices are able to come online and the massive opportunities that we'll start seeing when you can have embedded sensors all over the place and data being transmitted in near real time.
I see those too. And in the last few minutes that we have here today, what else should we cover that we haven't?
I think one other change that I was reflecting the other day with a mentor of mine that I think we're seeing and certainly have seen in the last 20 or so years is the changing board structure and structure of corporate governance. I think we hear these stories about things that have happened at companies like Uber and WeWork, and look at the boards of these companies, and these are really powerful, smart, successful people. And you sometimes look and you're like, how did they let the company make that decision or the CEO do that? And I think what's happened is that a lot of investors are willing to take really big risks and try things out that feel maybe wrong or questionable without too much oversight over the CEO, because they want these big risks to pay off. And I think that investors should take seriously the piece of their job that's serving on boards, and encourage boards to really do their jobs to be there for the CEO, not just as their cheerleader in the corner, but really bring in the accountability. I think that also bringing in industry experts earlier in the game to join your board can be a really valuable thing that I think has become less common in the early stage startups today. The board makeups sometimes lack that expertise. And I think it's a big thing that we should kind of push for and make sure we're bringing some of that structure back.
Well, that's a good point. Well, how best for listeners to get back in touch with you?
So we're actually right now working on a new website refresh. So hopefully that's live by the time this goes live. So that's where our website is hyperplane.vc. And I am on LinkedIn, Samara Gordon. My email is samara@hyperplane.vc. So please do feel free to reach out and get in touch.
Great. We'll add those to the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you so much.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org.
Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.